welcome everyone to this evening's webinar. We've got 10 property investment experts in 10 weeks, and the guest tonight is Aaron Christie David, who is the Director of Atelier Wealth. All right, now first of all, what we might do is just provide you with a very quick disclaimer. So every single thing that's mentioned tonight is of general information, and all the content does not constitute legal, financial or personal advice and should not be relied upon as advice. We recommend that you, both Aaron and I, strongly recommend that you get specific legal, financial and personal advice according to your own specific situation before you take any action whatsoever. All right, now I am Julie Crockett, CEO of Australian Property Investment Solutions, and whilst this business that I run is a Sydney-based buyer's agent business, we help people in Australia and internationally to buy residential property situated right around Australia. And this live webinar series is designed to provide you with specific, up-to-the-minute information on the property market, and each week my guest will have a focus on one very important aspect of the market. Their task is to provide you with 10 frequently asked questions and the answers to them. This is to help you to get through these next several months of uncertainty, and it also gives me great pleasure to introduce tonight's guest, Aaron Christie David. Now, Aaron is a very amazing professional in his field. Aaron is a mortgage broker, and he is the co-founder of Atelier Wealth, which is a multi-award-winning mortgage broking business. And it's aimed at helping busy professionals buy their first investment property and build a quality portfolio. Some of his and his team's recent accolades include they've ranked 76th out of 18,000 in the mortgage profession, in the Mortgage Professionals Australia's Top 100 in 2019. And also they've been recognised as one of Australia's top 10 property specialists in finance. Also, they received not too shabby, I'll tell you, the winner of the Brokerage of the Year for less than 5 staff at the Australian Broking Awards last year in 2019. So what a superb outcome that is for such a young team and a very experienced team, I must add. So, Aaron, if you'd like to go through, now I've just pulled up your slides, what are my options if my job is impacted? If you'd like to go through answering that question, that would be fantastic.
Yeah, sure thing. So yeah, to give everyone a bit of background, my focus is on mortgage broking and mortgage services. So I guess the number one question that's come up from borrowers, whether it's investors or people with their own home loan, really is what happens if their job is impacted. So we've seen people potentially take a 20% reduction in their incomes, or completely impacted depending on the industry they're in. So if you have a loan, the process is to contact your existing bank. So unfortunately, your broker cannot assist with this. You have to go directly to your bank. And unfortunately, some banks are lagging in their turnaround times. And I think the last stat that we heard was one of the big banks fielded a year's worth of calls within a week. So you can naturally understand the amount of pressure that banks are under, trying to serve their customers as well. So I guess to answer the question here, you have a couple of options. One is you can take a pause on your loan. So effectively you're taking those 6 months of the break, and then what we're going to do is capitalise the interest into the loan. So your repayments effectively will go up because you're taking that 6 months. The interest will still accrue, and then it gets added back into the loan. So that's one. A couple of banks have also extended the loan term out by 6 months, but it's a little bit same but different. I guess what we need to understand is, can you handle the additional amount of 6 months worth of interest over the life of the loan? And my short answer is probably. And I guess if it continues after 6 months, well, that's a different story where banks kind of will look to extend help packages as well. I can give a full list of all the lenders. We'll put together a help list of every lender, the website and the contact number about who to call there. So Julie can share that with everyone who's registered for the webinar, just like that cheat sheet on who to contact and where to go for help.
Fantastic. For those who are on the call tonight, if that sounds like something you'd be interested in, then please pop that in the chat box. Just say yes, please, if you'd like a cheat sheet on those banks that are offering some help. Now, Aaron, just a quick question on that. Do the banks give you any, or give their customers any indication of what the costs would be involved in taking a freeze on the loan?
Yeah, sure. So there's no direct cost as a borrower. I guess the only cost out of pocket would be the extra interest expenses that would come up as a result of extending your loan term. So the extra interest over 6 months, they get added into the loan. It's probably the big one.
Okay. Alrighty.
Perfect. Yeah, and I think so as we kind of move through, the next big question that we're getting a lot of inquiries about, especially from investors, is my tenant has been impacted. And so what does that mean for me as a landlord? Now, this is probably where having a really good property manager as part of your team will help steer you based on the state's policies that's happening locally. So I guess across the board, we've just gone out to a lot of our investors and said, hey, reach out to your tenants first and foremost and find out if they're impacted. So a lot of the states have got forms that you can fill in where they actually have to show that their jobs and their incomes have been impacted by COVID. And as a result, they can apply for some hardship arrangements. But I guess if your tenant has been impacted and this impacts your own personal cash flow, then it almost goes back to our previous question, which is maybe what do you do if your own personal cash flow situation is impacted as well?
I think that's a really good one because I know that there are some people potentially on the call tonight who that very much is the case. Thank you, Carol, for popping that in the chat box. Yeah, we'll certainly get that through to you, that cheat sheet that you've requested. Okay. No, this is an interesting one, Aaron. Should we fix or not fix? What to do?
Yeah, this is it. Look, I have a very firm view on this, and look, it can be a little bit polarising, but I'll go with it for the conversation. So my short answer is probably not. And the reason why is because we're still going to be, from all accounts, we're still going to be in a low-rate environment for at least the short term. And I guess we'll go to this when we talk about your property strategy. But in my mind, what's the benefit of fixing? It's to hedge against rates going up or to give you a bit of consistency around your repayments on that they won't move. If you fix your loan and let's say in 12 months' time, you need to refinance to another bank for a cheaper rate or a better valuation, or your current bank's policies don't allow you to borrow any more money, and you have this property that's fixed in for a certain amount of time, it makes it very hard as an investor to move your portfolio. And I guess the big thing that we always say is everyone wants the lowest rate, but if you end up paying a break fee to get out of this loan, any possible savings that you've had is now going to be eroded. You may even be out of pocket to try and move out of that existing loan with a fixed rate break fee as well. And I think that's probably where it catches a lot of borrowers unaware. And I mean, if we go back at the start of the year, even fixed rates were super attractive. No one really saw COVID coming, and now people want to get out of their current fixed rate loans, and now they're incurring break fees as well. So I guess it's just being a little bit pragmatic about what's your plan. So why do you want to fix? You might take the sugar hit and get a lower rate, but is that really going to give you the flexibility as an investor to be nimble and portable with your portfolio?
So important. And I guess, Aaron, it's important to point out here that often the break fees are not a few $100s. Yeah, I've got some personal experience with this one. I fixed a loan a while back now, and of course rates have dropped significantly, and I thought, I'll just ring the bank and just find out what the break cost would be. And I actually get out of it in September, but to break it from here to September was just over $6,000. And I'm sticking with it because it's far more cost effective to just pay it, keep going till September. But yeah, a lot of people would be feeling that pain right now, I should imagine. And you've pointed out a few home truths, I guess, in terms of fixing loans and the strategy behind it. So yeah. Okay.
And I guess, and I mean, who sells the fixed rate? I mean, let's be honest here, it's a bank, right? So the banks aren't going to put out a price they're not going to make money on. There's plenty of smart people inside a bank working, the margins on a home loan. They've got to know enough intelligence about where, potentially rates may move to, or where they may move to with their own rates. So that's why I feel like fixed rate, unless you're bunkered down, you're not going to do anything to that property for the next 2 years. Great, you can fix it for 2 years and set and forget. But if you have itchy feet as an investor, you want to grow and you build your portfolio, maybe just hold back fixing if you don't absolutely need to.
Oh, absolutely. I think that's good advice. Very good advice. Okay. Now this one pops up quite often, I'll bet, Aaron, with the benefits of principal and interest versus interest-only loans. So what's your take on where that's headed and the benefits?
Yeah, the benefits will really come down to which camp are you in? And what I mean by that is, are you in the camp that while rates are low, that you want to pay off the loan? And so what that's going to do is, the rental yield may be great and you could afford to make the repayments of principal and interest, so you're not impacted by cash flow, which is great. I mean, you're going to build more equity. The value may go up or it may hold steady for a bit, but at least your debt level is coming down against that property, which is going to create more equity in it. That's the upside for being principal and interest. The downside is, because you're paying the principal component, you can only, as an investor, really claim the interest part from a tax point of view. So the principal components going into the loan, could that best be held back if you want to buy potentially your own home, or you want to do something else with that principal as well? And that's where you may look at the interest-only option with an offset account. The interest-only typically is the lower repayment. So that's why it's favoured investors, because from a cash flow point of view, it's a lower repayment. Now, what we've got here is rates are still low, but I mean, for an investor, we're still talking over 3% as an investment interest-only loan. You might be saving close to 1%, 0.5% on a P&I loan. So that's where we really just run the numbers. Say, look, here's your payments P&I, here's your payments interest-only. What's your rental income, and then what are the outgoings? So if we look at it purely from a cash flow point of view, that can start to make, I guess, the decision for you about which camp you sit in, whether it's P&I or versus interest only.
And would you help run those calculations for your clients, Aaron?
Yeah, absolutely. I mean, it's all part of what we're doing. This is one of the biggest questions we get. So we've got pretty good at kind of working out, okay, from a repayment and a cash flow point of view, what are the in costs and what are the out costs? And I touch on it later that we don't need to make things overly complex. And that's why I keep those calculations very simple. We should make decisions pretty quickly, and this is one of those as well. I think the other big thing that comes up is, should I have an offset account or a redraw? To me, again, very simple, very clear message. Get an offset account, and if it means we need to pay an annual fee, we pay the annual fee. What you may have heard within the last 2 weeks, MeBank came through and took people's redraw funds and paid down loans, for example. So if you're relying on redraw or offset, we are always trying to get investors to look at using an offset account rather than relying on redraw.
Okay. Can you just run us through exactly how that happens? So if a client happens to have funds sitting in a redraw account as opposed to an offset, the bank can basically help themselves to that and repay debt. Is that what you're saying?
Yeah, look, it's an anomaly, isn't it? Like, you don't use it too often, but Commonwealth Bank did it in 2018. Me Bank's just done it as well. These are uncharted territories, and these times are uncertain. So banks can, and they've got every authority to sweep what they call sweep funds from a redraw account. And so I guess the way you look at redraw versus offset, are you parking your money in the loan, or are you parking your money against the loan? And so again, we're always trying to explain things in really plain English. So if we said, okay, redraw means you're putting money essentially in the loan, and then you've got the ability to draw it back out. That's redraw. If you're looking to have the money sitting against the loan, well, that's going to be in an offset account, and it gives you that liquidity because, let's say, for example, job impacts, or there's cash flow impacts, or there's an issue with one of your properties and you need access to $5,000 for maintenance. Well, that's there in the offset account potentially. You can get that. Whereas if in a redraw, you're at the mercy of bank policy, that if they decide to pull that redraw, you suddenly lose access to your own funds. And so we always want to be in control as an investor of our own funds.
100% correct. I think banks, and this is just my personal opinion, banks tend to have way too much control anyway, and to just allow them, I guess, to have access to those redraw accounts without fully knowing the extent of what you're getting into, then that's really dangerous. But thanks for pointing that out, Aaron.
Banks are always going to ask. Banks are always going to ask. It's not to be rude, but banks are going to ask to do what's right for them. They've got big client bases. They can't consider the intricacies of every single client. They're going to make big wholesale decisions that will impact us at an individual level. But just understanding that, being aware of it.
And can I say here to everyone who's on the webinar tonight, if there's anything in the back of your mind that's sort of spinning around, I think it's really important just to ask those questions, to bring them to the forefront, and if there's any doubt about anything that's happening in finance world, then by all means ask those questions, because it's good to get clarity around it. Now, for those people who are on the webinar tonight, it'd be lovely to have a show of hands here in terms of how many people are doing an interest-only loan at the moment. Okay, how many have got interest-only loans? Let's pop that in the chat box. I'm just interested to know. And okay. No, that's really good. That's really cool. Now, thank you for that, everyone. All righty. Now, this one, Aaron, is a really interesting one, and it pops up all the time for me. And I always refer straight away to a fabulous mortgage broker like yourself. Isn't it the aim to get the lowest interest rate? And that's what most people believe. Give us your lowdown on that, Aaron.
Yeah, it's one of the, maybe how mortgage brokers kind of pitch themselves to go, hey, let's get the lowest rate, let's get the lowest rate. And yeah, that's certainly the goal here. But I think what we're trying to do is see beyond the lowest interest rate as well. And where we're trying to get clients to see is you need to choose a bank that aligns to your property portfolio and your growth plans as well. So to give you an idea, let's say like the lowest rate at the moment for a home loan is ING, a great bank, for example. But what we call their assessment rate, so how they stress test your loan, so their lowest home loan rate, I think, is at 2.09%. But to get an ING loan means you need to stress test that loan at 8%.
Wow.
Whereas some banks are nearly half that, like 5.6%, for example, as their assessment or their stress test rate. So maybe you don't qualify for the loan at 8%, for example. And so that's what we're trying to get people to. They might dangle the low rate, for example, and see some other lenders that come through that have really high fees as well. And that's another part that you can get caught out with, say, hey, I'm going to chase the low interest rate, but now they're stung with all these fees. So the lowest rate is one of these illusions where you can get drawn into it, but if it's not the right loan that's going to let you, pull out equity, for example, chasing the low rate and going there, and suddenly means you have to move again to get equity out. It's a more expensive exercise than kind of taking a step back and trying to judge lenders not just on the interest rate, but also their bank policies as well.
That's really important information, that one, because and that's why I sort of selected that little graphic there, because it is a little confusing for people who don't understand the full extent of what a loan entails. And as you rightly just pointed out, there's so much more that we need to be looking at, not just the interest rate. So does anyone have a question that they'd like to ask about interest rates? If you're in the chat box there, by all means pop them in and we'll give them a little run through. Fantastic. Alrighty. Now this one's a really interesting one, Aaron. I've put up here a supposed portfolio for you, and that whole question of, how do I know if the bank's policies are limiting my portfolio growth? The whole idea for the vast majority of investors is to build a property portfolio, but if you're actually, if the bank's not working in your favour, you may find it very difficult. So give us your take on that, Aaron.
Yeah, absolutely. Look, we work hand in glove with banks, right? So I'm certainly not dismissing them, but you have to understand some banks' policies aren't specifically geared towards investors building a portfolio. And what do I mean by that? So some banks, let's say for example, have what they call shading on rental income. So again, in plain English, what that means is some banks will accept maybe 100%, they'll take 100% of rental income. Some banks will take 80%. Some banks will take 60% of rental income. So if you do the math, if you're getting $500 a week of rental income, some banks are only going to use $400 of rental income, which over the year you're losing nearly $5,500 of potential rental income, and that's $500 just on one property. If you have a couple of properties, it just compounds at that point as well. Some banks will then say, hey, we'll take 80% of rental income, but we'll also add in all the additional expenses that come with having an investment property, call it strata, council, insurances, property management. So they're almost going to take those expenses out of your disposable income. It's like they're taking 20% of rental income less, and they've also put their hand in your pocket for those living expenses. Now that's true and accurate because we need to make sure that we maintain those living expenses, but it's also the way they've stress tested potentially your interest-only loans as well. So what that means is if you have one of your existing loans on interest only, then they'll recalculate the repayment on a P&I term over 25 years, which dramatically shoots up the repayments as well. So on one hand, yes, the banks are very responsible and they're taking a very responsible view of how your portfolio looks. But on the other hand, what they're doing is really drawing back your ability to borrow and gear up as well as an investor. And then you kind of overlay this. So these are some of the common bank policies that hurt investors. So living expenses is one, HEC debts, credit cards, lease repayments, if you get bonus income, overtime, commission. But every bank has such different policies around just those income types, income sources. How could you possibly navigate all that? And I guess that's what, it's not certainly tooting our own horn here, but that's what we do. Like we navigate all those options to say, hey, look, you might get a salary sacrifice here because you work for a non-for-profit, but banks don't see it that way, and that may hurt how much your borrowing capacity is. Whereas some banks really do well with that. Why don't we look there if you're trying to maximise your borrowing capacity? So it almost goes back to the previous point, which is, hey, I want to get the lowest interest rate, but if that bank doesn't do your income type or helps with your portfolio plan, again, you've missed the point here about trying to get the lowest rate, but trying to build your portfolio ideally.
And herein is the where the strategy comes in, isn't it, Aaron? With if you're wanting to build a property portfolio, then you really that's specific then to everything else that happens with your finance. So therefore, someone like yourself would be able to source the best possible lender who would then be able to work with you to build that portfolio.
Yeah, correct. And some people have ambitions, Julie. Like some people really have the ambition to grow a larger portfolio, and some people don't have the same aspirations. They're happy with a handful of properties, and there's nothing wrong with that. But we want to help you get there. So, and that's where the whole strategy is. It's understanding what do you want to achieve here, and can we find the right lenders to align with your strategy? Because they need to fight for your business. They need to earn your business. It's not just kind of like the other way around where you have to go begging for a loan from them. Actually, you know what? Let's take back some power as an investor and find the right lenders that understand your journey.
Yeah, 100%. Wow. Okay. Who's getting good value out of this tonight? I mean, I think this is amazing to be able to, unpack the little mysteries that I find them mysterious of loans and lending policies, and understanding how important it is to actually, get it right with the strategy first up, and then finance that strategy accordingly. Whoa, okay. Now, the next one that we've got, multiple valuations. Now, first of all, perhaps, Aaron, let us in on, what banks do, when they do valuations, why they do valuations, to give us a little bit of background on that.
Yeah, definitely. I'd say valuations is probably the most underrated part of the investor journey. It's probably where I can see investors make or break their portfolio. So to understand valuation, let's say, for example, you want to refinance your investment loan to another bank. Some banks will choose to do a valuation on the property up front. So most brokers will be able to access what we call upfront valuation. And some lenders will say, if you only submit an application to us, only then will we order a valuation. So what we want to do is we want to try and order valuation up front with banks, so we don't go through the whole application process to then find out what your property is worth, if that makes sense.
Yeah.
Yep. So then we start to and we've got example after example. But I've got one that's so recent. We did an investor. He's got 5 properties across Australia, across different markets, and he's got one property in a suburb called Epping in Sydney. And we did valuations with 4 different banks, and we got 4 different results that range from $750,000 to $950,000.
Wow. Mm-hmm.
And we did one in St Kilda down in Melbourne, very, very similar thing. Got valuations that range from $825 that went to about $930. And so we're going, hang on, we can pick the top 2 valuations. There's plenty of equity in these properties now. Between the two, going up to deposits to then go again and buy another property, that's the mix as well. Whereas if you've gone and the one that came back with the lowest valuation had the sharpest rate, it kind of goes back to that point that if we're chasing the lowest rate, what happens if someone could get you an extra $80,000 in equity to help buy your next investment property? You just completely missed the trick there. And so being able to have access to a broker that has multiple valuations is one part. But then it's also, can we rely on what they call desktop valuations, which is a computer valuation, versus sending a valuer out there as well? So how a computer or desktop valuation will work is if the loan-to-value ratio is under 80%, and typically if the property is under about $1 million, most lenders will give us the ability to do a desktop valuation. Now, if there's not enough data to support a computer valuation, or it falls outside sometimes the bank's perimeters, or our estimated value on the property exceeds what the bank thinks it's worth, that will usually straight away trigger a full valuation. And what that means is a valuer will need to go out to the property and then inspect the property, which has a couple of implications. One is we know that valuers are probably not as bullish on the property market, depending on where your property is. And the other part is it has impact to your tenant. If your tenant can't get access to the valuer, then that may delay the whole valuation process for you as well. And you don't want multiple valuers going there and affecting the tenant relationship as well. So I guess managing the valuation component and doing that in a very, I guess, methodical and strategic way can yield you much different results if you're willing to look at multiple lenders to do valuations.
No, that's perfect. I mean, if you could find another $80,000 worth of equity in property, you know, there's another deposit for an investment property sitting right there that you don't have to come up with yourself. That's brilliant. Fantastic. Okay, again, if anyone's got any questions, then please pop them in the chat box and we'll have another look. Now, what I've done with this one, Aaron, I've put the principal place of residence smack bang in the middle there and those 4 investment properties sitting outside it. So you're saying that, you know, you can get this terribly wrong or you can be very, very smart about it. So tell us how we do that.
Yeah, look, when I say rookies, I don't mean to be rude. I think if I just get in your face a little bit, it's how people remember this part, right? I think borrowers don't intentionally set out to cross-securitize their property. So when you say cross-securitize, cross-collateralize properties as well. So by this, and this comes up from time to time where people go, I didn't know the bank did that. So I can't blame clients for that because sometimes the banks will just do it because it's the easiest thing to do. And by cross-securitize, they take your property and just tie it all in together. The example that I've got in the last month is I had a client with a private place of residence and an investment property down in Bendigo in Victoria. He sold his home and the loan that he had was linked and cross-securitized with his investment property. The bank then triggered a valuation on his Bendigo property and the valuation has fallen short. So now what happens is to get that property refinanced, standalone, he needed to pay $100,000 down that property.
Okay.
And so you can imagine the conversation that I had when I'm like, why on earth would you pay down $100,000? One, of deductible debt, but also why wouldn't you just get another bank valuation done to try and roll that debt against the 80% loan to value ratio? So now he's lost $100,000 off his deposit for his next home, and he's lost the ability to claim the interest on that $100,000 as well. And not his fault. You know, I'm not pointing the fingers at the banks, but these are the unintended consequences that you get when you cross-securitize your home or cross-securitize your other investment properties and potentially you want to sell one or you want to refinance in the future as well. It pays to understand the repercussions and to have someone like yourself go into bat as well. Yeah, and it's trying to get, stopping people of having loans with multiple banks. I get it. It's inconvenient. You've got to remember multiple passwords. You've got multiple apps. You've got multiple logins. I get it. It's frustrating. But if it means come tax time that you've got very clean loan structures, for example, it's a small inconvenience to pay than potentially losing out, you know, thousands of dollars of deductible debt or tax deductible debt that you could claim. And that to me is the bigger picture.
Oh, absolutely. Again, it comes back to that point that you made a few slides ago about controlling your own money, being in control of your funds, and not where possible, not allowing, you know, the bank to get their hands on your hard-earned dollars.
Yeah, correct. Yeah, that's one big word is control. Control your valuations, control your property portfolio, control the rate. Because that's the theme here that we've got with our investors.
And one way that you can control it, of course, is to keep asking questions. Every time something pops up that doesn't seem quite right or doesn't sound right, ask questions. Yeah. Here's a complex one. Complexity is the enemy. Wow. Okay.
Yeah, let's try to keep it simple, right? I mean, this is the amount of times I get a call from someone or email saying, hey, I read on Facebook and SMSF was right, or we should do a 99-1 ownership with my wife or my husband, or I'm looking at co-purchase with a friend, for example, and we're going to buy through a trust or buy through a newly established company. Like, these aren't uncommon vehicles or strategies to buy investment properties through. I'm not being dismissive of that, All I'm suggesting that is if you're starting out on your journey, you probably have the borrowing capacity in your individual name to buy your first few properties. It's when we start to go and maybe hit a wall with your individual borrowing capacity, or you want to look at issues around, say, land tax, and you want to buy from different entities, or you're in a role potentially where you have liability, let's say a medical professional or a legal professional, and there's some personal risk that's at stake here, then we can start to look at what we call different structures or different purchasing vehicles, whether that's buying through a company, whether it's buying through a trust, whether it's buying through a self-managed super fund, for example. And the outcome is the tax benefits, for example, but sometimes it's not just the reason to do it. And I think when I generally come into these conversations, my first question is, what are we doing? And my second is, why are we doing it? If we can't have a clearly articulated plan, then we need to go back to the drawing board. And that's why I say complexity can be the enemy, because we can over-engineer it and rack up a lot of fees in under planning or accounting, which potentially doesn't need to be there.
Oh, I couldn't agree more. I think with this one, it's really important to work with your accountant. But in saying that, you really need to find an accountant, and we have very good accountants as part of our professional team, which Aaron and I'll talk about in a minute with as far as the team goes. But you really need to be sourcing accountants who understand property, and preferably those who are property investors themselves and have portfolios. And also, what Aaron just said is absolutely correct. If you're exposed to any risk in the industry that you're in, and you're a business owner, for example, then by all means, that's adds another layer of icing on the cake, if you like. But yeah, if you're just an average, and I say that respectfully, a PAYG earner, as you said, Aaron, it just pays to keep it as simple as possible. And then if circumstances change down the track, well, again, you'd ask more questions. You go back to those professionals who can advise you. But finance is one of those things now. It used to be pretty simple, Aaron, I must admit. When I started,
completely.
Yeah, when I started investing in 2002, it was a very simple, straightforward process. And certainly we didn't jump through hoops the way that we do now. So to have professional advice around this is pretty crucial. And to get that strategy in place is even more crucial, I think. Wow. Yeah. Okay. Now, the right team. Off you go, Aaron. What do you think?
Yeah. Look, I can often see times that people have the ambitions or the growth, and it's sometimes their team that can let them down. And that's the sad part, where people maybe in years gone past have had the ability or the capacity to buy properties but were given potentially bad or poor guidance. And that's the stuff that really breaks my heart. So can you imagine if I gave someone bad advice and years down the track they actually could have bought 2 or 3 properties, and they could have grown real well. Okay, we can't live in the past, but if we sought out good quality experts, it's the quality of your team, and that's really what we're trying to advocate here. And what I mean by that is, it's almost exactly what Julie said, was if you're going to speak to an accountant and they don't believe in property, we're going to run into a few hurdles in the future. Because as you're trying to be hungry and grow your portfolio, are they going to be the right person on your side? Whereas if you've got an accountant who has tread the path that you're planning to go down, built a property or has helped a number of property investors, they'll be able to pick up kind of your next steps or potentially what the pitfalls are going to be as well. And choosing the right team is just so hard. Like, how do you find the right property manager, the right mortgage broker, the right buyer's agent, the right quantity surveyor, the right financial planner? Like, there's so many professionals in those industries with low barriers to entry. Usually, how do you find who's right, aside from maybe referrals, right? So that's why I say ethics is very hard, and values are hard sometimes to quantify. But that's where, if you're having a chat with, and I'll speak in the sphere of, say, a mortgage broker, there's a couple of good questions to ask. And one is, okay, do you invest? How many clients do you have? The active investors? What do their portfolios look like? do you get paid by referral partners? So kind of what's the disclosure around referral relationships as well? And then how many lenders have you worked with? And I think that's probably one part that I'm really proud of our team, which is we've got access to 30 banks. In the last 12 months, we've used 25 or so, whereas the average mortgage broker will use 4 or 5. So again, we can kind of hand on heart say that we'll go anywhere to any lender to get the right results. But that we can do that because, again, we've got a good support team that can help our clients go through the process. And I think that's the other part that we're trying to advocate for is, you know, having a good network is one thing, but then you have to kind of get off your butt and then, you know, meet with them, pick their brains, and then that's the part that really becomes on your accountability list is to don't leave it with the partner to follow you up. Why don't you follow them up as well?
Oh, so true, so true. I think more and more I've found very interesting where people are moving into doing a lot more online. And, you know, for speed and for, I guess, convenience, people are, you know, looking to do all manner of things online when it comes to property investing. But I guess what I've found is when I've sat down with people who've gone down that track, it falls down when there's no personal relationship built up between the people that they're dealing with. So if problems arise, and sometimes they can be doozies of problems that arise, then they're caught between a rock and a hard place if they've already engaged this team online and they can't get what they need from them. And I guess you pointed out a really important point just then that, you know, it is a whole team of people that is required to purchase an investment property. And loads of people go it alone and they have to go through the process of selecting what they feel is the right person for the job. And in terms of team, when you work as you do, Aaron, as a professional mortgage broker, and as I do as a professional buyer's agent, we've established those people that we are aligned with and work with are true professionals in their own right. And that's, I guess, the benefit that professionals bring to the table is that they have a team established around them already that are what we call the A team. I mean, you know, I don't work with people that are half-baked and don't know their stuff. So, you know, it's so important for everyone on the line to understand that there's good out there. There's pretty average out there, and there's good, and then there's superb, and they're the people we deal with. All righty. Okay. So I guess, and we've just touched on this point, you know, who do I need on the team? And Aaron, of course, has gone through his slides tonight in terms of the frequently asked questions. And you raised a really important point there, Aaron, and I might actually I'm going to ask you on the hop, actually, if you can put together the questions that people need to ask if they want to engage a good broker. You know, what are those crucial questions that I need to ask in order to get the answers I need to know that that person, that broker, is going to do well for me and you know, be the professional that I hope that they would be. That's something that I think is so important for people. Who would find that helpful? Just put a yes in the chat box if you think that would be helpful to know the questions to ask a broker. Okay. All right. Now, the same thing with conveyances. Thanks, Carol. That's great. Yep. You need someone who can obviously transact the property. We've been through a few here where online conveyancing, they're few and far between in terms of the level of service that they provide. We only use conveyances that are the best around the country, and it's important to know that the job is going to get done. And if there are any sticking points leading up to settlement, or indeed when we get to settlement, that the professional that you're using to do the conveyancing will get the job done without you being having to pay any potential fees for, you know, non-settlement. So very important. Again, the accountant, we've touched on that. I won't go over that again, but you know, they need to be able to provide you with ongoing advice on how to build that portfolio. Ideally, you know, we need someone who's going to come alongside you and work with you, and they're the kinds of people that we also work with. Property managers can make or break an investor. And I mean to say there that property managers who are great at what they do and professional and are pro-landlord, they are worth their weight in gold, and you hold on to them for all they're worth, because the number out there that are only pretty average and who let things slip left, right and centre, and you're the one left picking up the pieces is, you know, it's just not a pretty scenario. So again, property management is one of those essential components of when you're purchasing an investment property that you absolutely have to get right. Okay, and any more questions? I think we've just thrown a whole lot of information at these people, but how much value is it out there to know where to go in order to get the right advice around finance, which Aaron's given us tonight, brilliant advice, and unpacked a few of those tips and tricks that, you know, we need to know before we launch in. And if we have launched in and we're in a mess, then let's rectify it. Let's sort it out for you. Okay, now we're here to take any more questions if you're wanting to put some in, but if you've got some confidential questions, then by all means reach out to Aaron or to me. There are our details there for you to reach out. I think it's really important to, when these times are so uncertain, just to have an obligation-free chat. We both Aaron and I are very open to just helping people at this point in time, as we always are, Aaron, aren't we? But just to open this up and to help everyone on their journey. I think we're going through some pretty tough times, and every little bit's going to help where we can. Okay. So, yep, Carol, we're going to absolutely reach out to you. Yep, so thank you for popping that in the chat box, Carol. We'll definitely get back to you. Fantastic. All right. Now, for those people that are on the webinar tonight, I just want to say thank you so much for joining us. We like to keep these webinars to around about 45 minutes to an hour in length, and we hold them every Monday evening. This one has been on specifically on finance, and what we're going to do next week is give you a property update. We do that once every few weeks in, and that will help you to understand what's happening in the property market right now. There's a lot going on in the media, and I would suggest that some of it is close to the mark and some of it's a long way off the mark. And I'll give you my own personal experience. I attended 2 open houses on Saturday. So open houses have just opened up again. We can all go and have a peekie at an open house. And both of those were on the North Shore, one in Mossman and one in Crow's Nest. Both of those were clients that popped up who said, look, we want you to negotiate price for us, Julie. We're not wanting to buy them as investments. We actually want to buy them as our own home, but we're having problems with negotiation because we don't actually know where to start to negotiate. And there's some very interesting deals going on out there right now in pretty much every level of the market, the upper end, the middle and the lower end. And so we've had some very interesting times negotiating 2 quite high-end properties for clients. And that's something that we actually enjoy doing. But what we've noticed is very, very few people at the open houses at this point in time. And the people who've got property on the market now are pretty much having to sell. So they're open to some really substantial discounted offers. So just to keep that in the back of your mind, if you're looking to purchase or to invest, it's starting to become an interesting time, and we'll keep you posted over the next few weeks. And I'm also bringing on board our research partner, so who's Ripe House Research, and we will be giving you an update blow to blow right around Australia of where are the safe havens to be investing now, and where are those locations where you absolutely must avoid. So that will be, we're bringing you some really good, valuable information over the next coming weeks. So stay tuned to our webinars. Thank you for all those people who've come on board. Thank you for the people who popped questions in the chat box, and we'll definitely be coming back to you. All right. Well, thank you, Aaron, for joining us. You were absolutely wonderful.
No, thank you very much.
Yeah, and great information. All righty. Well, thank you, everyone, and good night for now.
Thanks. See ya.
Thank you.
Thank you.